and thank you everyone for joining us for our 2023 Outlook. My name is Garrett Boyd, and I am here with my fellow advisors Russ Cesari, Glenn Cesari, Justin Valadez, Kim Heffernan, and Nikki Young. We have broken the Outlook into 4 sections: the economy, stocks, bonds, and policy. Before we kick this off, I'm going to share a brief disclosure. The information contained in this presentation is for educational purposes only and not intended to be a substitute for specific individualized advice. We recommend that you consult with your financial advisor for guidance specific to your unique situation. Please be advised that this presentation is being recorded for the purpose of sharing content after the webinar. And with that, I'm going to pass it over to Nikki Young.
Thank you, Garrett. And our outlook for the global economy is the starting point for how to find balance in 2023. And I'll begin with the annual forecast for both GDP growth and CPI inflation across global markets on the next slide. The global economy is most likely going to slow during 2023. And for the US, if we do see growth, it will probably be in the second half of the year. There are recessionary risks present, and should the economy head in that direction, we believe that will be in the first half of the year. We'll discuss more of those factors over the next few slides, but we're looking at a slow start to the year and a bit of a bounce back in the second half. For CPI, which measures inflation, we see it definitely coming down, but slowly. The Fed has a 2% target, and by year end, we believe we'll be closer to about 3.5%. The US has its challenges ahead, but appears to have fewer headwinds to growth compared to Europe and other developed economies, and that diversion is mostly because of inflation. Their inflationary data is more elevated than what we have here in the US, and there's also been challenges resulting from the impact of the war in Ukraine. Now, recent data has showed signs of improvement in the outlook for both the Eurozone and emerging markets, particularly with China. China has had a zero COVID policy that has been one of the biggest glitches in supply chains. And I think that they've figured out that you can't do that forever and expect your economy to grow. Moving forward to the next slide. So here we have the Conference Board's leading economic index. And we're currently seeing a healthy debate on what is the likelihood of us going into a recession. And that's because for most of 2022, not all the metrics were flashing warning signs. Business activity and consumer spending are contracting. However, recent data, including a stable labor market and decelerating inflation, suggests a soft landing may still be possible. The Fed is intent on bringing down inflation, and the tool that they're using is raising interest rates to pump the brakes on the economy, which will then decrease demand. But this is a process that takes time, and you can see with this chart of leading indicators that what they're doing is already having an impact. The leading economic index over a 6-month period is the dark blue line, and the shades of gray areas represent recessions. Historically, we haven't seen this much of a decline as we have now without there being a recession. Now, we're not saying that a recession is a guarantee, but if we were to head into a recessionary period, it would not be a surprise. And I think that's what makes this recession, that's what would make this recession different, because it will probably be one of the most anticipated ones we've had. And we know what it's about. It's the Fed trying to bring down inflation, and not because of a breakdown in a financial market like we've had in the past. So our take is that the US economy either narrowly avoids a recession or enters a mild and short-lived recession in the early to middle portion of 2023. And we can move forward to the next slide. So given the global economic data that we have, we know that most of the world's major economies are either in or very close to a recession, which is marked by slowing economic activity, contracting credit, and rising unemployment, which I'll touch more on the next slide. But recessions are inevitable, but the pain of them doesn't last forever. And what I want to emphasize here is what happens on the other side of a recession, which is recovery. And this is the period that starts our next cycle of growth. And to be able to fully participate in what that recovery has to offer from an investment standpoint, we have to remain resilient should we enter an uncomfortable recessionary time. We can move forward to the next slide. Now, despite the slowing of the economy, the job market has remained fairly strong. The Fed has repeatedly warned investors about the potential for pain from the fight with inflation. And what they mean by pain is the expectation that unemployment will increase as the job market cools from a slowing economy. That hasn't fully materialized yet. This chart, which is as of November of last year, shows that there are roughly 2 job openings per unemployed individual. We do expect that ratio of openings to fall as the economy slows and firms cut their number of job openings, which we've actually been seeing more of in recent weeks. So now I'm going to turn it over to Glenn, who's going to go into more detail about housing, the Fed, and interest rates.
All right, thank you, Nikki. So as we've all experienced, especially in the Washington, D.C. area, and I know some of our clients are not in the Washington, D.C. area, but there's been a surge since COVID in housing prices. That's been driven by low interest rates. That's been driven by the cultural change and shift to working from home, and the fact that even after, as we're coming out of this COVID era, lots of us are still working from home, maybe a few days a week, and frankly, a shift in the retirement trends for the baby boomers. They're spending more time at home, whether they're working part-time from home or have completely retired. So there's been, obviously you can see here in, well, as you know, there is an increase in home costs. We've seen that across the board. And one of the concerns or economic impacts is with rising rates is borrowing costs for homes becomes more expensive. As they become more expensive, that cools sales, and we can already see that trend peaking and coming down in 2022. We expect the economy connected to housing to actually be a drag on the economy in the first half of 2023 as the affordability of home ownership is hurt. And also, given the fact that a third of consumer spending goes to housing, that gives consumers less discretionary spending. So, we expect to see that in earnings. And now that being said, there is some demographic support to housing as millennials and Generation Z continue to seek opportunities for owning homes and household creation. So what may be a negative impact in the first half of 2023 might ultimately provide some tailwinds in the second half of 2023. But as the Feds end their tightening cycle and rate increases, there will be impacts to housing. All right. So speaking of the Fed hikes, as we can see, the Fed began to tighten monetary policy in 2022. And given the graph on the red line, you can see just how quickly and aggressively and in a short amount of time they raised rates. And you can see how they've done that compared to other times in history, going all the way back to the 80s, of where they've raised rates have been slower, longer, and frankly not magnitude, with the exception of 2004, the magnitude of hikes hasn't been. So this has been truly exceptional in almost every dimension. And there is some questions on what we believe the Federal Reserve is going to do in 2023. Now, the markets, we have seen that open markets we've seen a pullback in rates, both on mortgages, the 10-year. We saw what might end up being peak rates in the fall of 2022, but and depending on what the Fed does in 2023, we'll be able to better ascertain that. But as we see some of the volatility we've had in the market so far, is the markets trying to determine exactly what the Fed is going to do and when they're going to do it. So we've had 25 BPS early on, or 25 basis points, or 0.25% hike in March of 2022. That went to 0.5% in May of 2022, and we've seen 3.25% increases after that, and then more recently in December we saw 0.5% increase. So again, it looks like the Fed is getting more comfortable in getting their handle around inflation. Now we're also seeing the compounding impact of those movements on the $95 billion of U.S. Treasuries and mortgage-backed securities as they roll those off their balance sheet each month. Monetary policy does act with a lag, and the negative economic effects, have begun to hit the most interest rate sensitive industries, as we've already seen in housing. I think we'll continue to see that in housing. Business borrowing is another very sensitive area to increases in interest. Small businesses who use that as a lifeblood for growth, their borrowing costs become more expensive. So it does ripple through the economy, which is why research right now in investing is really wondering, is it going to be a soft landing? Is it going to be a shallow recession? It's going to be a deeper recession. And unfortunately, time will tell. Now, given that, here is a slide that we've shown on many other presentations. This is the Fed and interest rates. We can see historically on this gray line, the Fed funds rate that has happened and is currently dialed in is this solid gray line, currently sitting at 4.38%. Now, there's a couple different forecasts to follow. Right now, the blue dotted line is the Fed, the Federal Open Market Commission. This is what they are signaling to the market that they are going to do, roughly max out the Fed funds rate at 5.1% at some point in a year from now, roughly, early 2024. But the market has different expectations because the Fed has signaled these things before and changed course. And very much the market is paying attention to every word, every publication that the Fed is putting out. And the market believes that we're getting pretty close at 4.59% roughly a year from now. And then they expect it to, both the Fed and the market is anticipating a decrease in rates roughly a year from now. Now, the last expectation is the FOMC's long run projection, which their projection is always 2.5%, and that's not associated with any date. That is just their goal to get to. So you can see these two forecasts converging, and essentially what the Fed is trying to do is maintain a 2.5% long run projection. All right, with that, there is one more slide, and the team did a really good job finding this, and I commend LPL on putting this together. But one of the conversations about interest rates, as interest rates drive the investment cycle, what went into the inflation of 2022? And frankly, it's still a factor in 2023, but why was it so tricky to manage inflation? And so this shows this first circle, or pie chart, if you will, shows a typical inflation category contribution. And this is the pre-pandemic average. What you can see here in this pie chart, almost 81% of inflation would be contributed to services. The service economy. The other large part of it is really contributed to by commodities, right? The increase in prices of gas, natural gas, electricity, oil, metals, those type of things, the things that go into everything we make and everything we build has driven inflation over time. And goods is the other aspect of it. And typically, and I'm going to explain this -2%, goods have actually gotten cheaper year over year on average. When we think about the globalization and that we can build simple things overseas where labor and currencies are cheaper, that we've seen over time that goods have actually gotten less expensive. Now, if you go to see February of 2022, we saw goods become a large contributor. This is the blue. They went from -2 to almost 32% as their contributions to inflation in February 2022. That was supply, as Nikki referred to earlier. That was a supply chain issues, the things happening in China and other locations as COVID rippled through the economy. Inventories went up and they went down. We had shipping issues in the port of Los Angeles and other ports as container ships got backed up. So that became a logistics issue. Sometimes there were chip shortages. So goods became more expensive in that time period. Commodities also increased from 21% of the contribution to 36%. And services shrunk overall, but still were contributing to positive inflation, and they were at 33%. Now you can see by June of 2022, a Russian invasion dominated by food and energy. That really moved the needle on commodities. So they went from typically 21% to 35% to last summer, almost 49% of the contribution of inflation. Services were still higher, still high at 35%, and goods continued to make a positive impact on inflation at 16%. And then finally, most recently on this slide is where were we in November of last year, just a few months ago, and services were back to dominating the inflation picture. The commodities still were making a major contribution at 34%. And again, goods were still making a large contribution at almost 11%. So you can see the evolution in this slide of why 2022 was so tricky. This is part of why the Fed was raising rates so aggressively, because it wasn't one item they were targeting, it was all of them, all at the same time. And they determined that being aggressive, even if it hurt the markets, was more important than losing control of inflation, which is what happened in the early 80s. All right. With that, I will make a transition over to stocks.
Thanks, Glenn. So getting into stocks, big picture, when we're looking at the stocks and stock markets and what could happen this year, there's a lot of things we're looking at, but there's two things we're looking at. The first is the potential recessionary period, its severity, how long it lasts. And the second is really how much the markets have already priced in this slowdown and potential for a recession and what we're going through. When the sentiment about the markets is most negative, which has been the last few weeks, this period of time, that's in general when we become the most cautious. What does that mean for us going forward and in the stock markets long term? On the next slide, we're going to look at our 3 year-end stock market forecast scenarios. So we have a base case, we have a bull case, and then we have a bear case. So LPL Research puts this together. The base case really is that coming with a 60% probability, seeing the fair value of the S&P 500 end 2023 between 4,400 and 4,500 at the year end. For reference, today, At the time of this recording, we're just under 4,000, about 3987. So that is higher, ending the year higher than where we are today. And this base case really, and what kind of Nikki and Glenn mentioned, is going to be characterized by flattish growth in the economy this year, a mild recession with inflation and interest rates gradually decreasing, and ideally the Fed pausing the rate hiking cycle during the springtime. So this is what, based off of these probability weighted scenarios, I think was most likely to occur. The bull case then we have with 25% probability comes with a full soft landing, ending the year up 5,100 on the S&P 500, inflation falling faster than expected, and a full rate pause before the end of 2022, which obviously did not happen. Then we have the bear case with 15% probability coming with a full recession, inflation remaining stubbornly high, rates staying high or potentially even rising further through the end of the year, and the S&P down below where we are today at 3680. So the key part of it is going to be when it comes to the earnings side, and then how much of the slowdown is already priced into the market. So like I said, these are probability weighted scenarios. We're looking at these various paths for the economy, for inflation, and for interest rates and earnings. So on the next slide, we'll take a look at earnings a little bit. The base case for the earnings of the S&P 500 this year is $220. The public consensus is $229. So with LPL, we're about 4% below that number. $220 is where we were tracking for 2022. So they are forecasting not a whole lot of movement and essentially a flat year on the earnings side. The positives on the earnings could be that revenue could continue to get some boosts from inflation. We saw that at the end of last year, third quarter as well, that a lot of the companies were able to pass through these higher prices, but with the anticipated compression over the next few quarters, that's not going to help on the earnings end. The markets would welcome some gains in earnings, but will likely be relatively flat throughout 2023. The next few slides go hand in hand. We're going to look at a few different historical points for the stock market. So here we're taking a look at back since 1974 in the S&P 500. Stocks have most of the time risen after the end of a Fed rate hike cycle over the next 3, next 6, and next 12 months. So there are times when things were negative, 1974, 1981, 2000 stands out. But overall, we've had pretty good results looking a full year out after this cycle ends, looking at those 12-month bars. So towards the end of this year, into 2024, as Glenn mentioned, when we get some certainty on where the Fed is going and the timing of the last rate hike, stocks could potentially move higher, consistent with history. And those average after the next 12 months is an average 10% gain 1 year after the rate hike cycle ends. On the next slide, it's a similar chart, but looking more broadly at the S&P 500 in all years that it finished with a negative return. Separate from any specific causes or what was going on globally, stocks have also historically bounced back after down years. So same here, there's a few occasions where there was another down year that followed a down year. 2000 to 2001 sticks out here again. But during that period, the circumstances were different. We're in a different situation. So since 1953, following these down years, the S&P 500 has risen an average of 15%, with positive returns in 15 out of the 18 years that are shown here. Lastly, a different historical look at the S&P 500, but here, this is one of our favorite charts. We're looking at the performance since 1980. So in every year, we have the red dot on the bottom of the chart is the low point that the S&P 500 hit that year. The gray bar on top is where the S&P ended December of each year. So in recent years, we have 2020 with COVID. We hit a low point. We hit down 34%, ended the year up 16. Last year, we did hit the low point down 25% and ended down 19. But really with all of these historical charts and looking back at what has happened, we're wanting to see where these patterns are. We're looking at these historical patterns to see that last year was not the first time we had a year like that. We hit low points often. We hit low points every year. Some are worse than others, but they occur more often than that might stick out in our recent memory. It can be a year-end sell-off, like in 2018, a market correction throughout the year, a bear market, a full recession. But what we're looking at here is that they don't generally last. We could see this year looking something like 2009, still having that low watermark, potentially seeing more volatility and more losses through the first half of this year. But as we looked at, the base case is to end the year positively. It may not be 23% positively like it was in 2009, but up from where we are today. Time after time, the stock market has recovered from all of these disruptions, and ultimately they have been short-term declines and gone on to see those gains in particularly the year after. We know that it's tough to see statements and fluctuation, but the research behind it and why we look at all of these different scenarios is to see that similar things have happened before. Exactly what caused the volatility is different, and there's different pieces of the puzzle to put together. But if you were to have remained invested in the S&P since 1984, the average annual return is 8.7%, despite all of the ups and downs. So we're not out of the woods just quite yet, but stocks do still have a place in your investment accounts, and especially your long-term financial plan. I'm going to turn it over to Justin, and he is going to go through bonds.
Thank you, Kim. For those of you who have been attending our webinars for a while, we've transitioned from the pandemic and talking about recovery numbers and infection numbers over to interest rates, inflation, and the Fed's behavior. And certainly following a terrible, actually one of the worst years for bonds ever last year, this year is largely going to be influenced by the Fed's behavior, which will be guided by economic growth and the inflation data. Equally important is the level of non-US developed government bond yield. So think over in Europe, as foreign investors are an important buyer of US treasuries. Higher foreign market yields, all else being equal, generally dissuade foreign investment into our markets. And on the next slide, we'll go over a range of scenarios that could play out over the next year. So here the base case is flat growth, mild recession. Really depends on when we enter into recession. It seems consensus is that we go into recession this year. If we do, whether the Fed cuts rates this year or not would depend on the timing of the recession. Meaning, does it happen at the beginning of the year, middle of the year, or towards the end of the year? The less likely scenarios are a hard landing where we have more of a severe recession, and it looks like we may not be in for a stagflation environment, as inflation seems to have cooled, although will probably persist. It looks like inflation is not increasing each month as it was all throughout last year. Next slide. So hypothetical returns for different types of bonds, and really it depends on really here it depends on inflation and what the Fed does with interest rates. Again, the base case is probably not much of a change in the interest rate environment, which would lead to a rebound in positive returns for bonds. We see actually if we have rate cuts, much like last year when we had rate increases, it really hurt bonds. If we go in the opposite direction and the Fed starts cutting rates, if we go through a severe recession, that would actually be a positive attribute for bonds. And then if the Fed has to raise rates, if we're in that stagflation environment, they may hurt bonds a little bit more, but very unlikely that we see an increase of 1% from here. We're probably in the no change to up or down slightly camp. Next slide. So less than 10% of outstanding debt needs to be refinanced before 2025. Most companies knew that we were in all-time low interest rate environment and were able to refinance existing debts over the last few years and push their maturity dates out. Actually, only about 1% of existing debt needs to be refinanced in 2023, and less than 10% needs to be refinanced before 2025. So the need for companies to refinance debt at the existing higher interest rate levels seems to be muted, which is good for overall company profits. You can go to the next slide. So we're going to talk about policy a little bit, just following up on the midterm elections. Very close than anticipated. As expected, Republicans did gain enough seats to win a narrow majority in the White House, while Democrats, of course, held on to their slim majority in the Senate. And we'll go to the next slide to see how that votes historically in the form of returns. So stocks have always gained a year after midterms, no matter who's in office. And historically, midterm years have been very volatile for markets, and 2022 was no exception. The third year of the presidential cycle has historically been the strongest, and a weak 2022 may help set up that pattern again. A note of caution on that: increased fiscal stimulus in anticipation of the presidential election has often supported returns in the third year, and given the amount of fiscal stimulus we've seen over the last 6 years, probably a good thing that we're not expecting much of that for this year. So we see in all scenarios here positive returns on the market, and we'll delve into that a little bit more specifically for what we're in on the next slide. When a Democrat president with a Republican or split Congress, it's been a strong combination for stocks. Mixed government is kind of the best scenario for stocks. Markets had tended to favor mixed government since neither party is able to give its worst excesses, or any legislation that does get passed is subject to compromise. And so we look here with a Democrat president and a split Congress. We have a average return the year after of 15.9%. Next slide. Staying calm amid market volatility. So we just want to reiterate why staying invested is important. And we know years like last year really test our patience and nerves with reading those year-end statements, and last year kind of no bright spots, continuously down throughout the year. This just shows a hypothetical of $100,000 invested over the last 20 years. It doesn't include last year. Unfortunately, this chart won't come out probably for another few months, but there's plenty of things we went through in 2021 and the preceding 20 years before that. And if you stayed invested, now it is 100% S&P 500, your return is $616,000. But if you miss the 10 best days in the market, your value is actually less than half at $282,000. And I have no clue which 10 best days there are. And some of the best days we have in the markets are followed by the worst days. News comes out very quickly. If we go through recession, there's probably going to be a lot of negative headlines. But on the other side of recession is the Fed eventually cutting rates, and we will get past it. And as that news comes out, we'll see markets shoot back up. So there again, all of the things we've been through at the bottom here, whether it's the tech bubble, the financial crisis, trade war, most recently COVID, and the market downturn we saw in those periods of time, shorter periods of time, and then the next 12 months, markets rebound as the uncertainty maps itself out and we move on to the next issues. So with that, I'm going to wrap things up and hand it over to Russ for some final comments.
Thanks, Justin. What you see in front of you is what we call the heat sheet. This is a composite, a global view of the manufacturing and services combined, which we call a purchasing manager's index. And what you're looking at is actually a quarterly view back from 2009 to current. And with the exception of the far right-hand side, that is a monthly view of it. And when you look at this heat map, the colors are based on the purchasing manager's index. We look at this closely every month to see what the direction is. And the PMI is relative to 50, meaning at 50, it's neutral. Below 50, it is decelerating. Above 50, it's accelerating. So you can look at it just from a color standpoint. If you go back to 2009, which was right after the Great Recession, you can see there's a lot of green with some yellow in it until we get into 2020, which was the COVID recession. Then, of course, green after that. And now you're starting to see some yellow and red. And it's also broken out into the developed market and the emerging market. If you look on the left-hand side of your chart, you can see both of them are, either at 50 or just below, so decelerating. And then on the developed markets, you can see that by country what it looks like. And you can see from the U.S., we're at 45. Now, I think part of that is because the central bank or the Federal Reserve was the first and most active in interest rate increases, and their goal was to slow down the economy and bring down inflation. The other countries have also started to increase interest rates. I think one of the things that may help Europe is, although they had the inflation, a lot of it was caused by energy prices, and of course they're having a mild winter, so that's helped them some. But the U.S. has been the most aggressive from interest rate increases to slow down the economy and bring down inflation. When you look at the emerging markets on the bottom, you can see they're probably in better shape. You have to remember now, last year China was pretty much closed down, so they're reopening the economy, which is the second largest economy in the world, so we'd expect them to have some acceleration. India being in the best position. So we look at this closely to see the direction of goods and services, what's happening geographically. Currently it's decelerating. A lot is based off interest rates, but it's not only interest rates, it's also dependent on what we call M2, or the money supply, how much money is out in the economy. And we all know how much money the government has sent out during COVID, trillions of dollars, which is still out there in the economy. So that's an important part of this. Interest rates is only one aspect of it. The futures market, I think, is projecting that the Fed will have maybe 3 25 basis point increases. First one, they have a meeting at the end of this month, so they'll have some announcements at the beginning of February. We're expecting a 25 basis point increase in interest rates, after the 50 basis points that we had the last time, which was 25 basis points below the 75 that they've had. So you see a global view of some deceleration in economies. At some point, the Federal Reserve will have to stop their interest rate increases, maybe at some point pivot and start taking them down. Not sure when that'll happen. It's all data driven. So we'll look at this and keep our fingers on the pulse of goods and services by geography to see where the opportunities are. I think I really appreciate the team going through all of the different data points that we're receiving to see the direction of how we position the portfolios to take advantage of what's going on globally in the marketplace. So with that, I'll turn it back to Glenn.
All right, thank you, Russ. So that is all for a couple more disclosures here that I will walk through. And I'll put these up on the screen. One thing I would ask of you, if you have questions, when you have questions, please reach out to your financial advisor. Obviously, your plan is unique. Your needs, your goals are all completely unique to you and your plan. And so how 2023 plays out will have profound impacts on how what action is taken now, what risk and reward that is laid out in your portfolio is time sensitive, but some are more time sensitive than others, and really work with your advisor to dovetail your needs, your goals, and mapping out when you move, when you make decisions. So please reach out to your advisor. With that, again, thank you for being our clients. Thank you for choosing us. We know you have a lot of choices, but also thank you to the entire team. The team put this together and continues to dig really deeply, both on information we can utilize to provide, helping you all meet your financial goals.